Hello, you're watching Dukascopy TV. I'm Ben Jones and this is the week ahead. Joining me on the line to discuss the key economic events of the week is Tom Wales from Oxford Analytica. Now to begin with, Tom, there is a lot of data from the US this week, including on Thursday the preliminary GDP, with employment data out the day after. What are you expecting from these two releases and how will they affect both the US and the global economy?
Well, I think what we expect from the GDP revision is first a sort of slight upgrade to Q3 growth, but that's, not really as material as the fourth quarter figure, which is the figure that everybody's looking forward to. That, of course, won't be available to January, but pretty much the market expects a significant slowdown caused partially by the government shutdown, but also by a kind of shift in inventory building, or a downshift in inventory build anyway. The employment data, net job creation, we expect to come in at around 200,000 or just under, and the employment rate has been sort of bumping up and down. Overall trend is down, but occasionally it bumps up because of increased participation. We expect that the trends should continue to slowly come down. Maybe it will bump down to about 7.2%. From the current rate, which is 7.3. But both of these metrics are really significant insofar only as they affect the Fed's calculation when it comes to deciding on beginning the tapering of its quantitative easing program, that is, its asset purchasing program. And that's not something that we expect until significantly later in 2014 than most of the market expects. Inflation has been incredibly quiescent in the U.S. In fact, there's some concern, including at the Fed, that about deflationary pressure. And, job creation has been steady, but it has been rather unspectacular.
On Tuesday, we have the Reserve Bank of Australia rate statement. The rate is currently at 2.5%, but do you see it changing at all?
No, I don't think there'll be any change. We don't think, and our economists here are quite convinced that there won't be any change, and I think that's the general market consensus as well. The Aussie dollar has come off pretty significantly against the U.S. dollar recently. That's in part because of the slightly slower growth in China. We saw some more PMIs this morning, and the overall outlook for Chinese growth, as the government itself projects, is for continued somewhat slower growth as the government in Beijing attempts to shift the structural basis of the economy, which will be an incredible challenge there. But that means that Australia, which has really ridden Chinese growth over the last decade to pretty spectacular prosperity, and it completely avoided the global financial crisis and recession of 2008 to 2009 on the back of Chinese growth. That means the Australian economy is headed for a period of significantly slower growth. You occasionally hear people get very excited about the idea that Australia is sort of a bubble on top of a bubble, that is an asset price, particularly a housing price bubble built on top of a Chinese growth bubble. I think that's a little bit overdone, but it wouldn't surprise me if the governor said something about asset prices, because that's an ongoing concern there, although one that I think they have under a decent degree of control.
There is another rate statement out on Wednesday, this time from the Bank of Canada. There's also Canadian trade balance. Again, do you think there'll be any change in the rate set by the bank? And looking at trade balance, how important will this data be for the Canadian economy?
Well, Canada if Australia is really in the China zone, Australia is very much in the NAFTA or U.S. zone. Canada came through the global financial crisis and recession pretty well because of the combination of strong bank regulation and its natural resources boom. But really, it's run into trouble recently because of a combination of factors. One is increased U.S. competitiveness. The second, which has had an impact on the first, has been occasionally a very strong loonie. That is, the Canadian dollar has been very strong against its greenback counterpart. And another factor, or a factor driving both of those two things, has been the natural resources boom in Western Canada, which has created a kind of very mild version of what's sometimes known as Dutch disease, and that is a kind of a resource boom that decreases the competitiveness of a country's manufacturing sector by basically boosting its currency to the point where it loses competitiveness against its main trading partner. And to some degree, that's happened in Canada, and complicated by the fact that it's sort of a regional question where the West has been strong and the East has been weaker. This year, though, in really the past 18 months, has seen a decline as well in investment in the natural resources sector, partly because Canada has these infrastructure bottlenecks where it has trouble exporting its resources to any market other than the U.S. That's particularly true of oil and gas.
Thanks for joining me today, Tom. Now that's all we've got time for. Make sure to stay tuned throughout the week as we cover these events and more. Goodbye.